Right, we're taking stock of the macro data that has come through earlier this evening from the US, where we're seeing stronger than expected jobs data. So the unemployment rate has slowed marginally, and it has slowed to 4.1%. This is according to the December data that has been put out. The non-farm sector has added a whopping 250,000 jobs in December. It's in contrast with the 150,000 that was expected. So on the back of this robust jobs data, we're seeing the 10-year bond yields and the spot gold futures rise and spike in trade. And that's weighing heavily on Wall Street. It's clearly spooking it. Let's find out where the markets could be headed and what the larger implications are for the American economy. For that, Santosh Rao is with us, Head of Research and Partner at Manhattan Venture Partners. Mr. Rao, always a pleasure getting in your perspective on what's going on in the US, its economy, and of course, what's happening in the markets there. So what does this strong showing in jobs data for the month of December say to you about the strength of the US economy? Because it's happening in the face of high labor costs and all the global uncertainty as well.
Yes, I think the state of the US economy is very good. That's what this labor market, this report shows, that the job market is good. People have jobs, things are growing. But on the other hand, if it comes to interest rates, which is a big focus right now, we want to bring it down so it's not restrictive for the economy to grow further. I think that's where the action is. In terms of jobs, anytime you have more jobs, that's good. And anytime unemployment comes down, that's good. So, but the Fed's main concern was that actually Fed was not concerned about the labor market. He thought it was under control, it's coming down. But now this report shows that it is tightening further and further. So that's going to put upward pressure on inflation, on wages, and all the stuff. So there is a lot of we have to go back to the drawing board now. We have to see where things stand. The Fed has to rather two cuts that was penciled in. Doesn't look likely, maybe one and maybe not none if the strength continues like this. So I think that's the big debate right now.
Yeah.
So let's see, on the face of it, the knee-jerk reaction is that it's bad in terms of the interest rates, in terms of being restricted, but the good news is that people have jobs.
That's right. So, of course, it has spooked Wall Street, but isn't it also true, because there is a dichotomous view about the American economy, because we were just kind of collating data about consumer habits shifting. In the US, the retail sector has been struggling. So how are these job losses in this area affecting the overall employment figures, according to you?
Yeah, no, I think the retail sector has been pretty good. The consumer is holding up pretty well. On the edges, yes, he's going down the price line. The discretionary probably is kind of taking a hit slightly, but I think the majority of the retail is okay. It hasn't fallen off the cliff yet. So I think I don't think and that's a big issue right now. The consumer spending is up slightly, albeit, but it's still growing. And jobs are there. So I don't know exactly why the big issue there in terms of the retail market. It's pretty healthy.
Saying that it's on all counts, we are looking all right across sectors in the US market. But what's the outlook now in 2025? Given the expected slowdown in hiring and rising labor costs, the Trump administration is taking over, and there is the overhang of what all these tariff wars, etc., might bring to the table. Also, immigration laws. How do you think that's going to play out in the jobs market when the Trump administration moves in?
Right. The market is going to be very defensive at this point because all the Trump policies that he's stated already are inflationary in terms of tax cuts, immigration. That's going to spike up the labor market, labor rates. So and then just in general, he's going to be more growth supply side focus. So I think that's all inflationary, and that I think where the market is going to focus coming in is. Already he's kind of tempered it now. Before you saw the latest report, they said they wanted to cut 2 to 3 trillion out of the government spending. Now they're saying maybe 1 trillion. That's what Elon Musk said today. So things are, I think they're going to moderate their views. It's not going to be easy cutting costs, but they need to at some point if he needs to get his agenda forward. So a lot of ifs, ands, and buts, but net at the very high level, it is not good. The market is going to wait and see. It's a show me story at this point. Is he going to really go forward with all these pro-growth policies? So market is going to be very defensive at this point. And the rates are going to really cause havoc. So we don't want the bond vigilantes to come in and really cause havoc, but they are concerned. Already they were concerned about the federal deficit and the inflationary aspect of things right now. So that rate might go up beyond 5%. That's the big risk. And if that goes out, that's super restrictive. It's going to affect tech stocks. It's going to affect mid cap and small cap stocks that were showing some life because they have debt. So they will get impacted quite a bit. So I think things like that. So there are some repercussions if things don't moderate from here, and if it stays tight, if the labor market stays tight and inflation spikes up, there are some issues ahead.
So now that the Fed will have to go back to its drawing board, and of course it's spooking the markets right now because even as we speak, I'm seeing the Dow drop more than 300 points with this hot jobs report that we are seeing. It's sending yields much higher. They are clearly spiking. So what's the direction you see the dollar take on the back of all that's happening over here? The impact that you see playing out in the bonds market in times to come where these yields are spiking?
Yeah, the dollar is strong and it's going to get stronger because high yield, if he's not going to cut enough and the rates stay high, all the money is going to come into the US. The dollar is going to be strong. The yields are going to be strong. That's going to attract more foreign investments. So I think net overall, in terms of the dollar, which is not good for the emerging markets and the rest of the dollar denominated loans that other countries have, I think it's going to impact them. So it's going to slow down. The import-export balance is going to get shaken up a little bit. So yes, it's not. See, the headline today in terms of those things is not good. The economic variables, the dollar, the interest rates, and the inflationary aspect of it. So those things, those three things are really not really what the market wanted to hear at this point. So they were hoping for some more cut. They wanted the Fed to even cut more if possible, but two cuts, they had kind of accepted that, okay, we'll live with two cuts in the second half of the year. But now it looks like maybe one cut. But, we have to wait and see. Sometimes they do change the numbers, they recalculate the numbers, and they adjust the numbers. So let's see if this number holds, but looks like this is a strong number. Maybe here and there they'll shave a little bit, but the job market just looks like it's still very good. And this is something to consider for the Fed very seriously.
Yes.
As to give up that target of 2% inflation and maybe raise it to like 2.5% or 3%.
But I was looking at the FOMC minutes, Mr. Rao. Confidence over easing inflation is a key highlight of that, and they're looking at the strength in the labor market. So I'm wondering how much they've already priced this in. Further rate cuts are likely, they say, but there is no clarity on the quantum or the timeline for that matter. And there has been a unanimous vote for reducing rates to 4.5 to 4.75%, that kind of range. So if there is a recalibration, what kind of recalibration are you expecting? And what are the cues that emerging markets and the RBI in particular would take? Because like you're saying, they will have to recalibrate. So that uncertainty would have to mean that the RBI will also have to wait and watch.
They may have to, but I think the Fed's biggest fear was that they may have to raise rates. They didn't want to go back to what happened in the 70s where the Fed chair cut rates and then he had to go back and raise rates. He doesn't want that. So he wanted to, everybody felt that the 50 basis point cut was too dovish and he should not have done that much. Maybe stay at 25 and then watch and see. So he did that. So now he's going to wait. So I think at this point, the market had priced in two cuts. They thought things are going fine. They're moderated. They're going up and down, but they're kind of in moderation. But this one looks like a real spike up. So that's going to raise, definitely, they're going to sit up and watch what's going on here. And so the rates are going to go up. It's not really good. It's going to slow down. It's going to be restrictive overall. The economy is expected to grow, but that's going to put a damper on that aspect of it. The earnings expectations are going to be roughly around 14% for next year for the S&P 500. That may have to come down because the interest payments go up. So things like that. So it's going to have a ripple effect down the line. So net, not good. But in that sense, but the employment market is good in terms of people have jobs.
But Mr. Rao, how soon do you expect clarity to come about after the Trump administration does come in? You did mention that there is going to be an impact on the inflation story, which is something that the Fed is going to watch very closely. Now, how much time do the markets need to kind of wait and watch, in your opinion, after we see Trump take over as president?
I think two or three data points are important. The earnings reports are going to come out. Let's see where the companies come out and what they forecast for this year. It's been generally upbeat. They said they expect earnings to grow up. We're going to see how they calculate their forecast based on the interest rate factors and other pressures out there. So that those expectations, those forecasts are going to be very important before the next Fed meeting, because it's the end of the month. And then they will come out with their commentary, which will get some idea as to what they are thinking. But so I would say around April, maybe around the second quarter, end of first quarter, early second quarter, we'll have a better indication, more data points as to where exactly it's going. This could be a one-off aberration because of the holiday hiring and all that. We don't know yet. But net, we have to see how the future is, what's the secular rate is going forward. So a lot of issues to consider. At the headline is bad, but I think we'll have to look underneath the cover and see what exactly caused all this and where exactly it is, and then figure out. So I would say March, April is when we're going to really see we'll get a good sense of where the market is going and where the Fed is going.
Fair enough. But right now, you're seeing the Nasdaq also come under tremendous pressure, 1.25% cut. We're looking at 19,230 odd levels on the Nasdaq, and the S&P is down about a percentage point. It's now trading around the 5,860 levels. So yes, the markets are spooked. It's definitely very clear with what we are seeing, Mr. Rao, and the job markets, like you're saying. We'll have to look at the reasons why. This could be a blip, but there has been some impressive resilience in the past as well. It does face challenges under the Trump administration, and with this shift in political leadership, there could be an economic environment that would be filled with uncertainty. We'll have to wait and watch, like you're saying, till March, April to get clarity on where things settle. The labor market has to respond to these evolving conditions as well. Mr. Rao, it's always great getting your perspective. Thank you very much for joining us with it here on India Tonight.